Awesome. All right, guys, welcome to our Finance Friday weekly course. We do these every single week. And I'm excited to join you guys tonight. If you're just tuning in for the first time, whether you're on Zoom, whether you're on Facebook, whether you're watching the replay on YouTube, Instagram, DynamX University, doesn't matter. We post this a ton of different places, but we do these courses every week to talk about finances. Okay. Finances is a topic that for me is near and dear to my heart. It's been a source of freedom in my life. When I learned about it, my life started improving. Now, before I had that knowledge, finances seemed impossible, right? It seemed like something I would just never figure out. It seemed like something that, was reserved for the wealthy. I didn't have a good financial upbringing. I didn't have education. My parents weren't wealthy. We didn't know people that were wealthy. And so this money topic for me was just kind of mystical, right? And I went through this period for years in my life where it was just that. It was mystic. It was something that I didn't believe was real. It was something that I didn't believe I would ever achieve personally. And so I just kind of settled with that. And it wasn't until, I started getting into business where finances became important to me. Again, I realized that there are people that do have money, and I realized that those people aren't that much more intelligent, special, or any of that stuff, compared to how I was in my life. In fact, a lot of times I was harder working. I was a better student. I had better communication skills, and I couldn't figure out why was I not building wealth. And so fast forward till today, I've been in the financial industry 10 years now. I've been helping families build wealth, build financial freedom, get financially educated, become financially literate. And the result of that 10 years of work is I developed something called the blueprint to financial freedom. Now, when I say I developed it, what I actually did is I went back and I studied the wealthy people. I looked at who actually has the money and what is it that they do, right? Not what did Dave Ramsey say, not what did my teachers say, not what did my peers say, not what did my financial advisor, who's also broke, say. No, what did the wealthy people actually do? And so I studied this actually for years, and then I put together what I saw happening because I started seeing similar characteristics. I would read John Rockefeller's biography and I would see him behave a certain way with money. And then I would read, JP Morgan, and then I would read Andrew Carnegie, and then I would read, about all these people that actually historically not were just wealthy, but they were the wealthiest. Right? Like these guys built America. These guys are still historic figures. If you take John Rockefeller's wealth, he's still twice as rich as Jeff Bezos in today's, inflation adjusted dollar. So when I started studying this, I started seeing that these guys do similar things, and there was a definite pattern. Right now, I didn't go to college, but I'm smart enough to recognize a pattern when I see one. And so I started seeing the pattern, and I started realizing, okay, this is redundant. It's the same thing I'm seeing over and over and over with these people when they build wealth. And it's not what we're being taught in school. It's not what we're being taught in college. It's not what we're being taught by our financial advisors. It's not what mainstream financial services is pushing. And I saw that disconnect. So I started, really studying that. And what I put together was the blueprint of financial freedom. Now, I'm actually going to pull this up as well because I want to go through and show you guys kind of what this looks like. Now, this is based on the premise of a blueprint, right? If we think about a blueprint is a very definite, very specific way that we would build something, right? So if you have a blueprint for a house, that means that is the way you build the house. You follow that blueprint and you do exactly what it says, right? Which is different than, like, let's say stairs, right? If I said this is the stairs to financial freedom, you'd be like, oh, cool. I can skip 3 or 4 steps when I go up the stairs, right? Blueprints, we can't skip steps. If I was a construction worker and you hired my firm to work on your house and I told you we were skipping steps, you wouldn't be happy with me, right? So this is what the blueprint looks like. And I'm going to go through just step by step really quick with you guys on the different phases. Now, I want to lay this premise down on, okay, as we're going through this, we want to keep this simple. So if you guys have questions, drop them in the comments. As always, we're going to answer those at the very end. We'll go live with them, but don't be afraid to ask. This is something that actually could change your life if you dig in and you apply the information. I can't apply information that I don't understand, and I can't understand if I don't ask questions. So ask lots of questions. Now, phase 0 of this blueprint is freedom from the financial past. This was me. Right? This was me. When I first started, I wasn't even looking at building wealth. I was looking at how do I pay off my credit card that I borrowed money on like last year. and I still owe money and I don't know how to get rid of that. And that's freedom from the past when I get rid of this. So on phase 0, we're getting cash flow positive. It means that we're getting our income up and we're getting control of our expenses. We're learning the truth about money, which means that we're understanding the difference between money and currency, and we're acting accordingly, right? We're saving in money instead of currency. We're starting to save in actual real hard assets. We're getting on a forced savings plan. We're increasing income. We're reducing our fixed monthly costs. We're getting our credit built up. We're paying off debt. These are all things in the financial past. Now, the reason why I say that is when I don't know the truth about money, I start making mistakes inadvertently. And those feel like they're normal things because everyone around me is making those mistakes. Everyone has credit card debt. Everyone has a car payment, right? Everyone has money in the bank and with Wall Street. And so I start seeing that everyone is like this. And so it must be normal, but I still feel restrictive. Like imagine jumping into the water back there off my balcony and you just start drowning because you don't know what swimming is. And everyone around you is drowning and you're like, oh, this must be normal. It's really uncomfortable and I can't breathe. And I'm afraid I might die and I'm terrified, but everyone else is doing it. And they seem like they're, living a good life and drowning in the water with me. So this must be normal. And that's what happens on phase 0. We get out of that, right? So that's the very first layer. And then we move into phase 1, we get out of financial danger. This means that we're actually getting solvent. Our income exceeds expenses. Our assets exceed our liabilities. Our rewards exceed our risks. If I'm not this, then I'm insolvent, which means I'm constantly in financial danger. Insolvent means that one emergency puts me back at square 0, right? One spurt of unemployment, I'm broke, right? One medical incident and I'm done for. That's called financial danger. And so phase 1 is getting free from that financial danger. Then we move into phase 2, right? Freedom from the financial traps. Most people never make it out of phase 2. If they do get through phase 0 and phase 1, they get stuck in phase 2 and they stay there forever. The reason why is phase 2 is things like the mortgage, right? Things like the 401k plan, things like the mutual fund, things like the bank account, things like the car loan at 0% interest. All of this stuff that the banking system and Wall Street and the IRS, they create as products and services to get us stuck in. And what this does in phase 2 is these traps have us giving all of our money to the banks, all of our money to Wall Street, all of our money to the IRS, so that we're left with nothing and we live paycheck to paycheck. And again, it looks normal because everyone around us is doing it. Okay, then when we get into phase 3, when we get out of phase 2, we get into phase 3, freedom of income. We start investing for passive income, right? Again, how many people in your life do you know outside of Wealth Dynamics, outside of some of the investing communities? Let's just think about your workplace, your church, your community. How many people do you know that actually have passive income? Not a whole lot, because it's not normal, right? So then we get into phase 4, which is then freedom of multiplication. We start multiplying our net worth and getting over to the point of being what's called a sophisticated investor. And then phase 5, becoming an accredited investor, which is huge. When you're an accredited investor, there are actually deals that you get access to, investment deals that you get access to that non-accredited investors are legally not even allowed to know about, right? Like it literally is like, and I hate using the reference of the Matrix because I feel like everyone uses that for everything, but it really is like that. Like you don't even know that world exists until you become accredited. And then you're like, oh, this is why the wealthy keep getting wealthier, because they literally have things that I don't have. They have investments I don't have. They have tax planning I don't have. They have vehicles for their money that I can't even not only have, even know about, even receive advertising about, right? Then we get into phase 6, which is full financial freedom. Phase 6 means that we have passive income that exceeds our savings, our expenses, and our taxes. 40% savings rate, our living expenses, and we're not talking about beans and rice. We're talking about you're living in a good and comfortable life, and also taxes, which hopefully is little to nothing. And then we get into phase 7, which I don't talk about much because it's not something that's very relevant to most people yet. Phase 7, we've all heard the quote, own nothing, control everything. That's where that happens, okay? Phase 6, you become accredited. At phase 7, you become what's called a qualified purchaser. A qualified purchaser is an accredited investor, but for corporations and trusts. Because as an accredited investor, most people don't know this, you're not actually allowed to use an LLC in these deals. You're not actually allowed to use a trust in these deals. You have to invest as you, right? Which means you own it all and you hold all the risk. So there's even after that a threshold of, okay, well, I don't want to own it all because I don't want to be the one holding the bag. I just want the benefits of all this stuff. So how do I control it without ownership? And that's what happens on phase 7. And then phase 8 is where we start building your very own family office. This is where you create indestructible generational wealth, right? Now, the premise of what I'm going to talk about tonight is we are all very excited about phase 3 and above. I was too. I still am. Phase 3, love investing, right? Phase 4, love growing my net worth. Phase 5, love the fact that I'm accredited. It was very exciting when I got there. Phase 6, I'm going to be there in about 6 months where I won't have to trade time for money anymore, right? I'll achieve the PI greater than set equation. And so that's something that's exciting. 7, exciting. 8, exciting. And so what happens is I will talk to people that are down here on 0, right? They're on phase 0. They have debt and they are freaking obsessed with Rich Dad, Poor Dad, and these cash flow courses and all the stuff they're learning about. And it doesn't matter that they have $80,000 in consumer debt. By golly, they're going to do a flip. By golly, they're going to buy a fourplex. And they're over here trying to operate on phase 3 and 4 and 5 when they're not even on phase 1 yet. They're still on phase 0, right? Or maybe they're on phase 1 and it's like, hey, I know all this stuff. I'm cash flow positive every month. I'm doing some saving. I'm working on some stuff. I have a budget, but I'm insolvent. Meaning I owe more than I own, right? And some months I don't save money because some months my expenses do exceed my income or they're flush, or I'm underinsured and I have no liability protection with corporations, insurances, and entities. And I'm over here trying to figure out how to get secret access to accredited investor deals when I'm not accredited and I'm also not solvent, right? And so what I want to talk about tonight is what happens when we skip steps. Okay, because what happens for me is I don't like following directions. There's a reason why I'm an entrepreneur. I don't like listening to other people. I don't like following directions. I was a terrible employee, right? I always thought my boss was bad. I actually had good bosses. I just sucked as an employee, right? I was the guy that didn't like to listen. But that means that I don't like to listen. And so when I see instructions, I'm like, oh yeah, that's for the other people, right? I'm the exception. I'm the special one. Right. I also like going fast. I'm very impatient. So I like skipping steps. I like, if I'm going up the stairs, I'm not going to walk 1 step at a time. I'm going to try and get 2 or 3 because I like speed. And so what happens is I take that, which in my life has been very helpful, and I tried to apply it to this, which ended up being very unhelpful. And I'll explain to you why. There are very specific things that happen when a step gets skipped. And it's going to show up as as a symptom in our lives that we might not know why it's there and what's going on. I'm going to show you tonight that the root is we skipped a step. We skipped a step, and that's why X, Y, or Z is happening, right? Now, here's the thing. If we treat this like stairs, or we treat this like a race where it's about speed, then we're missing the entire point, right? Now, if we treat this like a house, or we treat this like a business, or we treat this like a good meal where it's about completion, then it's totally different. We might not go the fastest. Now, the funny thing is you actually will go faster. When I started following this, I went from floundering and going back and forth. I would take 1 step forward and 2 steps backwards, and I just kind of was stagnant. And when I started following this within 5 years, and again, in about 6 months, I'll be through on phase 6, but that was about a 5-year span of, okay, I'm going to do this plan and just do this plan. That's actually relatively fast. Now, I'm not saying for you, it will take 5 years. It could take less, it could take more, but I'm saying if I kept on doing what I was doing, which was randomly grabbing different things that looked interesting in my finances and trying to insert them into my life without following any sort of step, then I probably would have taken even longer because I never would have gotten traction. Okay. Now think about this. Every single thing in life is like this, right? If you want to have a good marriage, there are certain steps in certain order that you would follow, and that would result in a good marriage. And you could actually figure that out by watching somebody that has one. And if you do what they do, you would end up with a similar result, right? If I want to lose body fat or gain muscle, there's certain things that I would have to do in a certain order in order to improve my physical condition. And the easiest way, again, is to observe someone that already has that. They're in good shape. I'm going to do what they do, and naturally I'll have the same thing happen. That's how this blueprint was developed, guys. I was looking at, okay, this guy or this gal is financially ripped. What are they doing? They're top 1%er, and let's just figure it out, and let's organize it in a step-by-step fashion so that I can do it as well. All right, so I'm gonna again pull up some things here, and I'm gonna sketch some of these out as well. But if we look again at, I'm gonna actually start here at the top and kind of work our way down. And we're not going to talk about 7 and 8 today. We're going to focus mostly on 6 and below. Okay. So 6 and below, like at phase 6, I am financially free, which means that I don't have to work anymore. Okay. Now it doesn't mean that I don't want to work anymore. And so what I will see sometimes and what we need to watch out for is there are people that they'll get to phase 6, right? They'll get to phase 6 and they'll basically be in a position where they're not actually in phase 6, but they just don't want to work. And so this is where you see people trying to like scam their way into financial freedom, right? They're trying to do 0% money down deals on credit cards to buy a rental property that gives them almost nothing in cash flow, or somehow leverage their credit card rewards points, or, you know, borrow money from somebody to buy some deal that may or may not work out. And I call them unusual solutions, right? And after being in this industry for 10 years, I'll get on the phone with certain people and I'll hear that they're doing all of this weird stuff with their finances, and it's all very creative and it's all very real estate based, but they're making like nothing on it, right? Like they might make 1 or 2% margin, but it's a lot of work to try and string all of these unique creative things together. And so what ends up happening is their financial world ends up being a mess. They have this property, you know, it needs repairs. It's not cash flowing. They've got, you know, this property, they don't even know what's going on with it. They've got some underperforming or non-performing private lending deal that they did with their buddy who is a realtor, who also thinks he's a flipper, that told him, I can get a great off-market deal because I'm a realtor. You should loan me this money and I'll buy it and do the flip and pay you back. That guy didn't pay. They don't know how to collect on it. And there's all just this mess with their finances, right? And they might have, you know, several or even dozens of different financial tools. None of them are coordinated. And this person is obsessed with not working, which is a contradiction, because what are they doing? They're working because they have all of this unorganization in their life that takes their time. Say that's the symptom that happens if we try and skip to phase 6 before we're actually there. Phase 6 is a math equation, right? You don't have to force a math equation. 2 + 2 = 4. If you have to force the numbers, it's because you don't have the equation, right? It's a very definite thing. And so financial freedom, phase 6, is something that should feel very natural. When I'm there, I know I'm there, right? I'm not having to string together all these weird and unusual solutions and creative ideas to try and somehow force the numbers, right? Now, if we move down to phase 5, and I probably get this one the most, people that are not accredited that are trying to get access to accredited investments. Okay. Now, on this basis, there are funds that will allow you to do this, right? Like if you tell somebody that's in a private fund, I have money and I want to invest in a private deal, everyone and their uncle is going to tell you, oh, I have a deal. I have a fund. I need a loan. I have a real estate project. I have a this. There's no shortage of people that will tell you they have a fund and they need money. Okay. That's one thing I learned very quickly, is as soon as you become the guy that has money, everyone and their brother comes out and is like, hey, how do I get access to your capital? But I've had these people that, you know, they're on, you know, trying to be phase 6, but they're not, right? The people we mentioned that have all these creative solutions, trying to raise money from people that are on phase 5, but really not on phase 5, right? So you have the poser who thinks he's financially free, who's really not financially free, trying to become financially free by raising money from the guy who's trying to be an accredited investor, even though he's not. And so what you have is you have an unorganized broke guy fraudulently raising money from somebody that doesn't understand anything from anything, because they're not actually an accredited investor yet, right? And so with this, basically, as an investor, I can get away with, I'm not accredited, I'm going to lie about it and get into a deal. But I have to realize the reciprocal is I just gave my money to a fund that's willing to commit fraud. Right. I talked about on a prior course that as a finder in the accredited and the private investment world, if I were to take a client that's not accredited and advertise to them or talk to them about a deal that requires them to be an accredited, I can actually go to prison. I can be fined $100,000 per instance that I do that. So a fund that's willing to do that is willing to risk prison and $100,000 per occurrence, which means they must be pretty hard up for cash. Right. And so the symptom, if I'm not on phase 5 yet and I'm trying to skip to it and I'm trying to be accredited, is I'm going to be in bad deals that ultimately don't perform. Unfortunately, I have a client that actually did this. I told him, hey, you have to be an accredited investor to invest in oil and gas. He asked to be in my fund. I told him, no, you're not accredited. Sorry. He circumvented me, went around to a different guy, went into his fund, and he's like, yeah, I got in somehow. And I told him, like, dude, that's fraud. Like, I'm not going to be the one that blows the whistle. I'm not going to mess with your deals, but that's fraud. Guess what? The deal never paid. Okay. He put, I think 50 or 60 grand into it. Deal never paid him out. I think it maybe actually paid the first month. And then after that stopped and didn't pay again. Right. And then after that period, they got investigated by the SEC because they committed fraud. And now my client's there trying to get his money back. Right. There's a reason why these steps are there. Now, the other thing that'll happen is on phase 5, right? We talk about being accredited. On phase 5, you can get accredited by income, right? But the symptom that someone's going to experience if they get accredited by income is high income, no capital, right? Because the threshold to become an accredited investor by income is if I'm married, I have to make $300,000 in taxable income 2 years in a row, which means I'm going to pay probably 20 to 30% in taxes on $600,000. That's a lot of money, right? By the time I do that, by the time I pay my bills, by the time I pay my debts, because I probably skipped that step too, I probably have no capital left. And so while I'm accredited, I don't have 100 grand to do a deal. I don't have liquidity. And if I do have 100 grand, I've got no money in savings by the time I'm done, because that was all the money I had, because I'm not actually accredited. There's a reason why we go by net worth, is somebody that has net worth actually has liquidity and they have means to invest, right? And if they have net worth, it means they have been investing. See, this is the other thing that comes up as a symptom, is if I try and skip to phase 5, right? I've never done a private lending deal before. I've never done a real estate deal before. I've never done any sort of private fund. And then I go in on my very first deal and I try and do a deal for accredited only investors. I'm going to get my butt handed to me. Okay. In the private placement world, like, there's 2 angles to this. If you read my book, Blueprint to Financial Freedom, you know that this private placement and accredited investor thing was created by the wealthy, right? As a way to prevent the non-wealthy guy from getting in. Okay. Now, on the flip side of that, they're also unregistered, which means they're not regulated by the SEC and by FINRA and all these government agencies the way that a mutual fund would be, the way that an exchange traded fund might be, the way that a stock might be, which means they don't have to show you their books. They don't have to show you their cash flow statements. They don't have to show you their balance sheet. There's literally no requirements of that. Now, those that have invested in the funds I work with, we show them, because I tell my funds, you have to show us your numbers or we won't send investors to you. But legally, they don't have to. And so imagine I've never done a deal before. I have no experience in investing. I have no experience in anything. And I'm going into this $50 million real estate fund who doesn't disclose their numbers to me on a hope and a prayer that it's going to go right. Okay. That's the other thing that happens. And so with that, I'm either going to jump in prematurely and I'm going to lose money, or I'm going to be the exact opposite, because I know that I don't know those things. I'm going to try and underwrite the hell out of every single deal. And I'm going to basically be paralyzed, and it's going to take me, 6 to 9 months to make a decision, if I ever make one at all. And this is the symptom that happens for someone that tries to skip to phase 5. Now, the easy way is actually just get accredited. If I'm actually accredited, I actually have $1 million net worth. I've actually done 4 or 5 deals. I actually am saving 40% of my gross income. I actually have no debt. I'm actually insured properly. Everything that we've done below phase 5 is checked off. I have no problem with deals, because I understand them and I've done them, and I know my bases are covered. I have no downsides that are hanging out, with risk associated with them for no reason, because I've covered all those bases. Okay. Now, here's the other thing that happens. We talk about phase 4. Phase 4 is called the sophisticated investor. Okay. A sophisticated investor means that I've completed everything from phase 4 below. And also I have a $250,000 net worth, right? Now, another requirement is this term sophisticated, right? If we look this word up, let me actually look this up really quick. Sophisticated, and I guarantee that this is going to have something to do with experience, right? Sophisticated, so altered by education, experience, etc. So as to be worldly wise, not naive. So as a sophisticated investor, meaning I'm not naive and I actually have some street smarts with investing, I would actually had to have done some deals to get those street smarts. Right? Book smart means I read about it. It means I watched Wealth Dynamics University segments and I trained and I studied. That's book smarts. This is not saying book smarts. This is saying you actually have to be worldly wise, like street smart with investing. I can't get that if I haven't done deals before. And so what I'll see happen is I'll see people that they'll come to me and they'll be like, hey, I have a $250,000 net worth. Okay, I've not done any of the other steps, but I have a $250,000 net worth. Can we look at Forex deals? Can we look at life settlements now? Okay, they're not street smart with investing. They're usually not even book smart with investing. They just happened to make and save a lot of money and put some money in some retirement accounts, and the stock market did okay. And now they have 250 grand. Right. And so the result here is this person, if they jump from phase nothing to phase 4, you know, I just met you and I have 250 grand. Can you show me a deal? They don't have passive income yet. So again, it goes back to the experience thing. And also they're not saving, which means they're going to put their money into a deal. And then that money is going to be in the deal and that's it. Right? You have to earn, save, invest. If I'm not saving because I don't have passive income, because I put all my money and all my capital aside, and that first deal I did also doesn't generate passive income, it generates a compounding annual growth rate, then I can't save up for the next deal fast enough. See, there's a reason why phase 3 comes before phase 4. On phase 3, I do some deals. I build some passive income up. I save 40% of my income. And what that does is it allows me to accrue and build up for the next deal faster and faster and faster and faster, so that the waiting period between now and the next deal is shorter and shorter and shorter. If I skip that, I'm going to take my 50 grand, I'm going to stick it in a deal. It's going to grow at 10 or 12%, and that's awesome. And then it's going to be 3 years before I do another deal again. Because I'm not doing the prior steps. Right? So again, this is a symptom that would happen for someone that tries to skip to phase 4. Now, phase 3, freedom of income. Right? This is usually not when people try and skip. This is the one people try and skip to, right? When can I do my first private lending deal? When can I do my first real estate deal? And which is exciting and awesome. And I don't want to discourage that, but there's plenty of things we need to do before phase 3, right? So by the time we get to phase 3 and we're ready to do a deal, we need 50 grand to even do the deal, right? In addition to that 50 grand, we need 6 months of reserves set aside. So we probably need $80,000 to $90,000 total between reserves and cash for the deal. Now, if we're doing the deal with collateralized assets, like our sacred accounts, tier 1 using life insurance, tier 2 using gold and silver, tier 3 using a home equity line of credit, then we have something called a loan to value ratio, which means to have 50,000 to do a deal, I probably need to have 70,000 in the asset to be able to borrow against it. Right? So 70, and then we add another 30 or 40. I probably need 6 figures in fairly liquid assets to be able to start on phase 3. Right? That's a lot of work. Not only that, there's a lot of other things that I need to get set up before phase 3. So on phase 2, right, we talk about financial traps, right? So if I take, and I've talked about this before, if I take $100,000, and actually let me sketch this out for you guys. If I take $100,000 and I invest this at 12%, it's going to pay me $1,000 a month. Okay. I had to spend 100,000 to get 1,000 a month, 12,000 a year. That's a 12% yield, right? Now, if I have a more efficient use of capital, let's say I have consumer debt and I have 2 car payments, each of them $500, and each of those car balances is only 30 grand. So I have $60,000 in debt. And that's costing me $1,000 a month. Which one is a better investment? Spending 100 to get 1,000 or spending 60 to get 1,000? Spending 60 to get 1,000, right? So part of what we do on getting out of traps is we'll do something like self-finance your own vehicle, because this is a better deal than this, right? Similarly, let's say that we're on phase 2 still and we have a mortgage. And let's say that mortgage is, let's say $2,500 a month all in. That's our housing payment. And let's say that I can refinance this into a home equity line of credit, first position home equity line of credit. and I can drop my housing payment to a third of what it is now, which is $750. Right? And I can change this now to $750 a month instead of $2,500, meaning I've just freed up a difference of $1,750. And to do this mortgage, it costs me, let's say $4,000. Let's actually be aggressive. Let's say $5,000. Getting crazy. I can spend $5,000 to make $750 a month, or I can spend $100,000 to make $1,000. Which one's a better deal? 5,000 to make 1,750, right? Why wouldn't I do that? Why would I skip to phase 3 just to say I invested when I can spend $5,000 and save 1,750 a month, or I can spend 60,000 and I can save 100 a month? What if it's taxes, right? You guys all know how I feel about taxes, right? And I'm looking at this same comparison, and I'm looking at, okay, I'm in a 25% tax rate, and I can save $100,000 in taxes, right? And I can get this money back, or, and this is going to cost me, let's say $10,000 in tax planning fees is my cost, or I can spend $100,000 and make 12 grand for the year. That's not even a comparison. Like, why would we even be considering doing this and getting, 100 grand for my first deal when I can spend 10 grand and save 100K in taxes? Right? So I want to emphasize this because these are the things that we're skipping. Investing is cool. Investing is not as cool as saving 100 grand on my taxes by spending $10,000. Investing is cool. It's not as cool as saving $1,750 a month on my mortgage for the next 30 years of my life, or getting $1,000 a month. These are the things we're skipping. And the reason why we skip them is typically going to be one of two things. It's going to be either we didn't know, right? We were uneducated on the subject. We lacked the financial literacy, which is how we got in the traps in the first place. We didn't know any better. So we started putting money in the 401k, and we signed up for the mortgage, and we got the car payment because it was a really low interest rate. And then before we know it, we have no money left over at the end of the month, like I talked about at the very beginning, and we can't build financial freedom. Lack of knowledge is what puts us in phase 2 and having to get out of phase 2, right? So it's either lack of knowledge, which if it's lack of knowledge, then I shouldn't trust my knowledge because it got me in trouble last time. I should look at, okay, what are the successful people doing, like we talked about at the very beginning? Or it's unwillingness. I don't want to do phase 2. I would rather skip it, and I would rather try and do phase 3 or phase 4. Right now, you can skip it, right? If you want to, you can skip it. I'm telling you, in this scenario, we're building your financial house. I'm your general contractor. I am not going to skip it. When you say, hey, let's just the foundation, let's skip it. I want to go to the roof. I like the roof better. I'm more excited about the roof. I like the tools better when we build the roof. I like the idea. Let's just skip the foundation. All right, cool. You can, but I'm not your contractor anymore. I won't be a part of that, because when you go in your house, it's going to fall on you and your family, and people are going to get hurt and die. And I won't be responsible for being the guy that built the house for you. Right? So it's either I don't know or I don't care. And if I don't care, this is probably not something I'm still watching. I probably tuned out, at the very beginning when I heard, oh, there are things I have to actually care about. Right now, the other thing that happens here is, like we talked about, people that are still in these lower phases, right? They're still on phase 0. They're still on phase 1. And I want to single this one out because this is the one that takes the most time, guys. It takes the most time to learn how money works. It takes the most time to get my budget figured out. It takes the most time to build up a good income source. It takes the most time to fix my credit. It takes the most time to get out of debt. It takes the most time to save, and get 6 months of reserves built up. Right? Those aren't exciting things. They're fun when you get there. Like I can attest to when I first got 6 months in reserves, and I was like, wow, you mean my company could make nothing for 6 months and we're going to be fine? Now, I don't plan on making nothing, but that's a sigh of relief. It's not like, oh crap, how are we going to make payroll? Or, oh crap, how are we going to pay rent? So it feels good getting there, but the buildup is boring. It's not exciting. No one brags about, yeah, I'm putting money away, just saving for reserves. It's more exciting to be like, yeah, I'm doing private lending and buying real estate. Right? But what I'm saying is these ones take the most time. And if we skip them, then we don't have a foundation, right? Like I had a client this one time, he skipped this, right? Phase 1 and phase 2, jumped into this. And then after some period had an emergency come up. He didn't have reserves. He's like, hey, I need my money out of that private lending deal. And I was like, dude, that was a 5-year deal. You can't. You signed a 5-year contract. There's no way to get out of the 5-year contract. And so he was unnecessarily stressed out simply because he didn't do phase 1. He didn't build up 6 months of reserves. Right. And so the symptom of someone that skips phase 0 and phase 1 is typically problems and emergencies. Someone that has lots of problems and emergencies is somebody that skipped phase 0 and phase 1. Okay. Now this is the one where it's humbling, because I was somebody that skipped phase 1, or sorry, phase 0. I was a financial advisor, right? So I was doing investing in stocks and this and building my business. And I was up here in trying to become a financially free person, but I wasn't doing it this route. Like I wasn't investing for passive income. I wasn't getting out of the financial traps. I was getting into the financial traps and thinking I would become financially free. And so when I started working on this blueprint for myself, I realized, okay, by net worth, I'm up in this area, but by knowledge and behavior, I'm all the way down here. And so while I might be almost accredited, I actually need to step off my high horse and go all the way down to phase 0 and learn about the difference between money and currency, and get on a forced savings plan and get rid of some of the things that I have in my life that are financial traps. And so somebody has to be willing to voluntarily take 2 steps backwards and make sure they're following these steps so that they can be financially free. Because if they don't, then what can happen is involuntarily, these things will pull you backwards. Right? Involuntarily, they'll pull you backwards. Now, what we do is we walk with you through each of these. We're going to say, hey, you're not on phase 3 yet. I know you're excited about it. Let's finish phase 1. Right? We've broken this down into steps and phases and everything so that it's easy. And you just look at what step am I on and what's my next step. And if you do that, like what happens is you end up building and building and building, and it starts to compound. It's like a snowball effect. Right? And then when somebody does get to the point of being on phase 5, when they're accredited, they actually have to do a full financial audit with our CPA firm, right? So when someone tells me, Jerry, I'm accredited, I'm ready to invest, great. We're going to get all of your financial statements. We're going to get everything you have going on with your insurances and your taxes and this and that. And we're going to have our CPA firm perform an independent third-party audit. And if we missed any steps, you're not accredited yet. We're going to go back and handle those before. And you can say, great, that's fine. I'm going to bypass you and go look for deals. But that brings us back to, okay, we're skipping steps again. Why are we skipping steps? Why are we trying to build the house quickly instead of right? Right? Why are we trying to cook the meal the fastest instead of have the best food? Because this is not something that you're independent of. When you build this, you're the one that has to live with it for the rest of your life. Right? Think about that. What you build with your finances is what you will live with the rest of your life. So if I build and I skip steps and I have, random stuff going on and I've got financial traps happening, I've got debt, and it's all this unorganized stuff, I have to live with that till I'm dead. Or even worse, if I do a good job and I build it up well, my family has to live with it. Why do you think you see these families though, that they're the patriarch, the matriarch, they're millionaires, they're billionaires, they build up this giant asset base and then they pass it down to the kids and grandkids, and the kids and grandkids blow all of it? Because nobody organized the steps. They didn't do it right from the get-go. They might have struck, oil or done something great and made a bunch of money, but they did not have a system to follow. Right? It's the franchise effect. I'm not trying to build a boutique, best in the world single unit steakhouse in the middle of downtown. I want McDonald's. I want this to be Walmart. I want this to be Starbucks. I want this to be something that can scale over and over and over and generation after generation. And I can't do that when I skip steps. Because if I skip steps, guess what my kids are going to do? Guess what my grandkids are going to do? Guess what their grandkids are going to do? Right? So guys, this is a lot that we covered tonight. What I want to do is I'm going to open this up for some questions. If you have questions, drop them in the comments here and we'll answer those live. I'm going to answer Facebook first and see what questions we have there. If you guys are on Zoom, we'll actually go live on speaker and answer questions as well. All right. Good to see everybody tonight on Facebook. We have Eric, good to see you. Brad, good to see you. Josue, good to see you. I don't see questions so far on Facebook. Let me jump in on Zoom and see what we have here. So questions you guys might have could be about the phases specifically. It could be maybe you did skip a step and you're just realizing it, and it's a what do I do question. Maybe you don't think you need to do a step and you'd like to learn more about why you should, and maybe get a dialogue going about that. Jimmy says, would you say some steps are situational? Let me actually switch this on to my other speaker so I can go live with Jimmy here. All right, so we should be almost on with the mic here. Okay, good. Jimmy, you should be able to hear me now. Let me go. All right, we're just getting their mic straightened out. I'm going to go live here with Jimmy in just a second. We should have our audio and mic. Let me go ahead and bring Jimmy on live now. All right, we're live with Jimmy. We did it. How are you doing tonight, Jimmy?
Hey, can you hear me?
I can. Can you hear me okay?
Yeah, I can hear you. Perfect. Yeah, how you doing?
I am good. I'm good. So what is your question tonight?
So I have a question. So I have the book right in front of me. I basically am 0 to 4. What's qualified? That was phase 4, right? Or phase 3?
Phase 3 is qualified investor.
Right. Yeah. So I'm there, but the one thing that I did miss was the on phase 0 was and I believe we talked about it, was the credit line. How does that work? Like, did you have to go, like, when that happens, you immediately go back to that, or like how does that, like, in your opinion, like how should I approach that?
Yeah, so that's a good question. So with that, Jimmy is basically saying he's, financially on phase 3. He could be doing a deal right now, but also he's got, some stuff on phase 0. He didn't get his credit done, and there's a cycle where you fix your credit up and then you actually get funding. So for me, what I do on that is I don't do the next step. I go back, right? And so something like, fixing my credit, or, getting credit and reserves built up, that's going to actually help me with my deals, because sometimes they're going to look at my credit. Something might happen where I'm tight on cash and I need to use credit. And so what I want to have happen is I want to make sure that that step is taken care of before I jump into the next one. Otherwise, it actually creates a further backlog. It actually makes it harder to go back, because now I've got more of these future cycles. So I would not do 3 yet. I would go back, handle what you've got to handle in phase 0, get that knocked out, then jump back over to phase 3. All right, we have a question here from Nilufar. She asks, is the sacred account done on phase 0 or phase 1? That's a good question. So the sacred account is actually done on phase 0. And I'm going to pull this up again so that we can take a look at this. All right, so on phase 0, we are starting to learn about money. And so there's different steps on each phase. And so on phase 0, part of this is saving in money, not currency. That's precious metals. increasing income, and then reducing debt, insurance, taxes, and investment costs. So that's where the sacred account happens, is on that reduced Diddy step. And so that's going to look like, if I'm paying off debt, we're using the sacred account to do the debt buyout. Alternatively, also, if I've been saving in a 401k plan or an IRA or a retirement account, this is the final I on Diddy, is the investments. I would halt those and I'd do the sacred account instead. So that's where phase 0 is going to be. I think it's phase 0D if you have the book in front of you. That's where the sacred account is actually going to happen. Excellent questions. All right, let's see what else we have here on our Zoom questions and Facebook questions. Awesome. If you guys have more questions, go ahead and drop them in the comments here. All right, I don't see any on Facebook. And I think that might be it on Zoom as well. My good friend Jesuin has a question. Let's his name is actually pronounced Jazwan, just so you guys know. All right, let's go live with Jazwan here.
Hi, Jerry. Can you hear me?
I can. Can you hear me okay?
Yeah, good to see you and hear you. It was definitely very enlightening, this blueprint, how you have it, structured out with the different freedoms that it takes to achieve that ultimate freedom. So definitely. Yeah, my question was, I'm definitely, very interested in working with you on, every step of the way to build this rock solid foundation from the very beginning that just keeps compounding with, more and more knowledge and experience and, just ever increasing wealth. So my question was on the various phases. I think it was kind of the same question as the person before me. Like you do need to repair your credit and build it. Not just pay off all your debts and then have a ton of cash, laying around ready to invest. You do need to fix that, and in order to go up those phases, right?
Yeah, so you do want to fix credit, and there's actually there's a policy, and you'll know what I'm talking about, that I can show you that actually references this. But credit worthiness on the individual side, when I'm a person investing, not a corporation, not a trust, but on a person. Credit does play into effect. So a lot of times, if I'm trying to get, lines of credit, maybe on gold and silver, or if I'm trying to do life insurance lines of credit, or I'm trying to invest, credit can come into play from an actual scoring and reporting standpoint. And then also from a liquidity standpoint, I want to have 6 months in cash, my sacred account. And then I also want to have about 6 months in credit available. So in total, out of about a year of liquidity, if something happens, I can survive on cash and on credit, and I'm good for an entire year. And so that's going to be one thing. And then the second thing is, as you become sophisticated and you start doing some things like credit leasing, setting up a funding corporation, a lot of those things are going to ride initially on your personal credit. And so credit takes time, right? It's like seasoning. And so if I start this late, I'm behind the ball, and I've always got to try and build that up then and catch up, versus if I do that at phase 0 and I start really building the credit, I have all the way through to phase 4 to just let it sit and build and get better and better and better. And so by the time I'm sophisticated, I've got a badass credit score. I've got a badass credit profile. I've got credit lines I can lease out. If I do a funding corporation and they're like, hey, Jerry, you need to personally guarantee these for the first 3 or 4 of them, that's no problem to me. But if I've got like a 580 credit score and I've got 2 credit lines and I've got not a whole lot going on, and they say, hey, Jerry, you can't personally guarantee these because there's nothing to secure it. You don't have good enough credit. That's going to be an issue down the road. So it's one of those things. Definitely handle it at that point in time, and it'll definitely speed things up down the road. All right, let me see if there's any other questions here on Zoom or Facebook. Josue says, thank you. Awesome. Thank you, Josue. Good to see you tonight as well. All right, guys, I think that is all of our questions. So what I want to do here is we're going to wrap up. if you are watching this and you haven't gotten a copy of my book, Blueprint of Financial Freedom, you should definitely do that. That is what this webinar tonight is based on. This is the entire write-up on what I've done, what I learned from the top 1%. This is the system I followed to get to where I am at in my life financially. And so it's something you can definitely read and follow yourself. If you want to get a copy of that, you can go to jerryfetta.com/B2F, the letter B, the number 2, the letter F. Again, that's Blueprint of Financial Freedom, jerryfetta.com/B2F. Make sure that you do share this. We'll be back next Friday and we'll talk to you guys next time.